Hey, thanks for tuning into the video. My name is Jake Hoskins. I wanted to talk about stocks versus real estate as far as investing. And I wanted to do that because I think most people that start to get a little bit of money are basically faced with this decision of, do I invest in stocks, do I invest in real estate, or do I invest in something else? And I wanted to focus on these two because I think these are the main ones. These are the ones that you should be putting the most money into, and I think they're the most proven over time to be able to give you good, reliable returns. Before we get started, if you'll help me out and go ahead and subscribe to my channel and leave a like on this video. So this video is going to be kind of a compare and contrast video, and I'm not really going to be telling you choose this one or choose that one at the end of the video, but I'm going to be just kind of giving you the general characteristics of these two investments, and you can kind of make your own decision based on your skill set and your interests. So the first difference here, and the most obvious one, is going to be the minimum investment that you have to start out with. Obviously, real estate is going to be a lot higher minimum investment because you're buying houses and pieces of land and apartments and that kind of stuff. So you're going to have a lot of money. I would say just in the like $50,000 to $100,000 range in cash just to get started investing in real estate. And so that's going to weed out a lot of people immediately. But once you get up to that level of money, you can go into real estate and you can start building consistently from there. But the good thing about stocks is that you don't need more than like $5 or $10 just to get started, and you can buy fractional shares of companies. The second difference is that real estate is tangible, which means it's physically it's there, and you can go to your rental house or your apartment that you bought, you can fix it up, you can paint the walls, all that kind of stuff. With stocks, when you buy a stock, it's just a number on a screen. Now you do have a share of a company, so you are technically a partial owner of a company, but it's not something you can necessarily go to and improve it or manipulate it yourself. And some people like to have that tangible asset that they can point to, that they can go to, and they can take pictures of, like a house, and it just gives them a peace of mind at night knowing that my investment is sitting on the lot all the time. And some people like the convenience of stocks where there's nothing to repair or get messed up, and so it's a lot easier to deal with. The next factor is liquid versus illiquid. Now, when I talk about real estate is illiquid, which means you can't convert it quickly to cash. Obviously, the reason you can't convert your real estate quickly to cash is because not everybody is looking for that specific house that you have to sell. And you have to list it, go through a real estate agent, and then people have to find it in the listings and ultimately get up enough money to buy your house. And that can be a long process, and it can take months or even potentially years to sell a house. So that's one of the major inconveniences with investing in real estate. And that's a good thing about stocks, is because you buy stocks with your brokerage account, and you can go on the computer, and with one click you can have cash, and you can turn that cash with one more click back into another stock, and then click again and turn it back into cash pretty much instantly. So that's extremely convenient with stocks. Global versus local. Stocks are global, so we're talking about like macroeconomics, we're talking about interest rates, foreign currency exchange rates, supply chains. Some of these companies can have supply chains on every continent, and so the global economic environment matters a lot with most stocks. Real estate is more local. If you're really good at just knowing your area, your city, you can be really good at real estate investing because you know the areas, you know what's trending, what school district is better, what neighborhood is up and coming, what's the trendy place to live. So if you're really in tune locally, you can do really good in real estate investing because you can have that edge over some of the other people that may be coming in from out of town and don't know all those trends that you know. As we know, the stock market has many buyers. Pretty much everybody in the world with an internet access can be a buyer of stocks. And so that is a negative for stocks because you have millions and millions of eyeballs on every single stock and people studying these stocks 24/7, and they're trying to figure out, just like you are, if they can make a lot of money in this stock, if this stock is going to go up or down. And that can make it challenging at times because you're basically competing against so many other people. Whereas real estate, there's going to be a lot fewer buyers. Number one, because most of them are going to be local within your geographic region. And number two, like I mentioned earlier, there's just not going to be that many people that have enough money to buy a particular property that you're interested in. But going off of that, real estate is predictable because pretty much everybody knows what a house should be worth because a lot of houses in the same neighborhood are going to be built roughly the same. They're going to be roughly the same size and build. And you can have, professional appraisers come in and give you a value of your house, and all of those appraisers know pretty much to the dollar how much a 2-bedroom, 2-bathroom, townhome is gonna be valued at. A lot of times in very, let's say high technology stocks, nobody has any clue what a business should be valued at because we simply don't know how the product is going to turn out or how people are going to perceive this company in the future. And they may make a lot more profits in the future or a lot less profits in the future. And so it's very hard to assign a value to any company on the stock market, whereas it's easy to go to a house, assign a value for that. The next thing I'll say is that real estate is very cash flow based. What I mean by that is, you may buy some rental properties that you're renting out to other people, and so they're giving you rent every month, and you have to have that cash to pay the mortgage because you borrowed money to buy that house. So it's really hard to kind of move forward with any sort of pace in real estate investing if you don't have that consistent cash flow that you're generating off your properties. Whereas the stock market is more based on buying and selling. And so you can, like I said, you can turn your stock into cash by selling it and go buy another stock. If the stock goes up too high, you sell it. You buy it when it goes back down, or you buy another stock that you think is more attractive. And so that way it's based more on buying and selling instead of having, your steady cash flow to do your operations in your real estate operation. The unfortunate truth about real estate is that, you have to borrow money sometimes. You don't have to borrow money. Some people choose to. It's going to be a lot harder to get started if you don't borrow money, because you think like a $200,000 house, if you can borrow 80% of that, and so you would only have to pay $40,000, and then you just pay the bank back as you rent the house out. If you didn't borrow money when you were doing that, you would have to pay the full $200,000 up front in cash, which can be very difficult for us to do. Stocks, on the other hand, it's actually very, very bad to borrow money because stocks go up and down a lot. And like I said, nobody really knows the true value of a stock. And so banks can't really lend money against the value of a stock, really. Just because the values go up and down so much, and people can sell at the bottom and buy at the top, and all this kind of crazy stuff can happen. And so you can't and you shouldn't borrow money and get that financial leverage in the stock market like you can in real estate. So when you own a piece of property, it's sitting there on the lot, and it doesn't just sit there all sparkly and shiny all the time. You have to maintain it. You have to sweep the floors, paint the walls, repair the roof, all that kind of stuff. And that costs money and it costs you time. And so that's a factor to consider. You have constant upkeep with any property or piece of land that you own. You don't have to do that with stocks. You basically go on your computer, you check the prices, you check your allocation percentages, and that's pretty much all the maintenance that you do for stocks. So stocks are a lot easier to deal with in that sense. But with stocks, you don't get the tax benefits that you get when you own property. You have so many tax benefits when you're a real estate investor. You can deduct any interest expenses that you pay on money that you borrowed. You can depreciate the property over, like, let's say 25 years. You can depreciate it down to zero. Basically, every year you can deduct 1/25 of the property amount off of your earnings for your tax bill to save on your taxes. So that's really convenient. Amortization as well. You can deduct so many costs on the maintenance and all that kind of stuff with your rental properties. You can do like 1031 exchanges where you defer your capital gains if you sell a house and then immediately buy another one. So there's so many tax benefits. And in my job, I've seen a lot of real estate investors paying much lower tax rates. We're talking about 10%, 15%, whereas the normal working person is usually paying somewhere between 20 and 30% taxes. So that's an advantage that can really sway you into the real estate game. And again, you don't get any of that from owning stocks. You basically, whenever you sell a stock, you have to pay capital gains on it pretty much no matter what. So again, I say all this and I give you this comparison not to tell you which one is better. Overall, they're very comparable in terms of total returns. They're both going to give you maybe 10 to 20% returns, sometimes more, sometimes less. And it just takes a different kind of person to do each. And my recommendation would be to choose one, focus on one. And that may be a contrarian view to what you hear a lot of financial people saying. A lot of financial people will say to diversify as much as you can and go 50-50 on this and spread out your money across everything. And that's not a bad idea. But if you're talking about making money and making the highest return you can, I would say focus on one of these, because otherwise you're going to spread your capital too thin. You're going to spread your time and your study time way too thin, and you're going to end up having bad returns in both. So I would rather focus on one and really maximize my returns just in that one thing. And so that was kind of the main message of this video. These are your two main options when you have some money to invest, and just think about your skill set and what you're good at and what you're interested in, and go from there and really put your focus probably into one of these two, and you can really make some good returns because both of these are very good investing options. Again, thanks for watching the video. I hope you got something useful out of it. If you did, like and comment and subscribe, and I'll be doing more videos like this in the future. Thanks.